Hi guys, welcome to another video. If you're new here, I do in-depth stock market analysis videos on all kinds of things, these SPAC companies, penny stocks to buy now, disruptive technology companies, dividend-paying stocks for passive income, all kinds of things. But this is not investment advice. This is an opinion channel about money. So in this one, I want to get into this CLII SPAC. It's the one that's looking to do this deal with EVgo to bring them public. So this one is actually part of a series on SPAC mergers. I'll link the full playlist up here. If you're into SPACs at all, it's definitely worth checking out a lot of those videos. So the way I like to do these things is I like to build both a bull case and a bear case, each one supported by a number of different points that I'll pull out of the underlying deal. And if you stick around till the end, I'll give you my opinion on which case I think is stronger. So let's get into it. Okay, so first up, let's take a look at the blank check company, the CLII, the climate change SPAC. This one's led by David Crane. Interestingly, he's actually a former CEO of EVgo back when it was spun off by NRG. So he knows energy companies. He knows this particular business. He knows investment banking. So this guy, together with the team that is in place at CLII, I think they're really strong. And I think they're probably in a good position to do this deal. The deal itself is pretty unremarkable. It's going to inject about $230 million in cash into EVgo and another $400 million from PIPE investment. It's a bit heavy on the PIPE, which I don't like so much, but it's more and more common with these deals, so nothing out of the ordinary. That particular deal would put the company at a $2.6 billion valuation based on the $10 SPAC share price. The deal would close in the second quarter of this year, and the ticker will switch over to EVgo, predictably enough. Now, if you look at the history behind EVgo, they were basically a spin-off by NRG back in 2010. It was launched back then by David Crane himself, the guy that's now heading up the SPAC, to try to move that company into renewables. Didn't go all that well at the time. There was I think, a history of larger issues with NRG that sort of hindered the pivot that they were trying to make at the time. But EVgo itself was a successful venture. It got sold in 2016 and then again just recently in 2019 to private investors, and it's done well enough through that period. It's a very early stage company. I think they were ahead of their time, and so I think it struggled a little bit as they built out in the early days. But on the good news side, they have, I think, paid their dues in terms of developing the technology, developing the business model, going through those early stage growth pains to expand. And right now, I think it's an interesting time for them, right? I think they're well positioned to maybe make that pivot into where EVs are going to be in the future. Now, before we go into the bull and the bear cases, I think it's important to understand the business model that EVgo is in and where they are sort of positioned in the market. They're basically placing a very, very heavy bet on the growth and the viability of DC fast charging. So if you have an EV, I'm sure you know all about this, but basically level 1 charging is just plugging your car into a normal outlet and doing basically a trickle charge sort of scenario. Not all that useful for charging. The bulk of the charging that we see today is level 2 charging. So it's 240 volt charging, and you can easily get a full charge overnight in that kind of scenario. So that's what most folks are doing at home or at an apartment building or this type of thing. DC fast charging, though, bypasses that pesky AC conversion, puts DC current directly into the battery. So it's really, really fast, and you can get a full charge in like an hour, maybe less. So it's really the cream of the crop in terms of charging speed, and it opens up a lot of additional use cases in terms of the ability to charge up your vehicle while you're eating lunch or shopping at the mall or something like that, and getting a full charge going from empty to almost full in a very, very short time span. So that's where they're trying to play. They're betting that that's the future, and that is the requirement for EVs go forward, and that level 2 is probably going to get left behind in the dust. Now, today, if you look at where EVs are, I think that makes a lot of sense. I think that fast charging is required in the commercial space where you have a lot of stop and go action in commercial EVs. I think it makes sense in retail for longer road trips and extended commutes and things like that. People need to get back up to full pretty quickly. So I think those use cases do make sense.
What's the upside potential?
Okay, so point number one in the bull case here, I always like to look at the team that's leading these things, both the team on the SPAC side and the team on the actual target company. I think both are a good story on this one, you know. I like the SPAC. I like the fact that it's led by David Crane. Crane was actually fired from NRG in 2015 after 12 years there. I don't think that reflects badly on his performance. It was really, you know, related more so to the struggles of the company and what the share price was going through at the time and all that kind of thing. I think that he did a good job at that time. All the articles that were written at the time were positive about his performance at NRG. And I think, you know, regardless of what happened then, he certainly knows the business, he knows the company. And I like the fact that he's coming back now to lead them into going public. I think that's nothing but positive. I like LS Power. I like the other investments that they have in renewables. So, you know, these are not just random investment bankers. I think they're invested in renewable energy. They're heavily invested in a lot of different ventures. So I think they have developed deep expertise in this kind of thing. I think they're the right ones basically to form this SPAC and take this company public. Point number two here is the tailwind that these guys are going to experience from the adoption of EVs. I think it's undeniable that the EV adoption curve is accelerating. It's massive. I think it's coming fast. You know, if you look back a few years ago, right, I think that people were disappointed in the adoption rate of EVs. We kind of expected that there'd be a heck of a lot more action by now in 2021 than there actually is. But that said, I think we're still in that sweet spot in the adoption curve where we're about to see that explosive growth. And I think it's more likely now that we're coming out of that period where things have lagged a little bit. So these guys are absolutely going to feel that, right? Like they are going to grow in lockstep with the overall adoption of EVs, which we all know is going to be pretty incredible going into the future. If anything, we might be even underestimating that adoption rate of EVs because future tech is coming and we can't see what that is. We don't know what it is, but I think there's a really good possibility that future innovation is going to only accelerate this curve. And I think these guys could absolutely benefit from that tremendous amount of growth that's coming. Point number three is the partnership model that they're now getting into in terms of the business model. You know, initially their initial business model was to really own these charging stations and brand them and sort of become like an EV gas station sort of thing, I think. And I didn't like that so much because that comes with a high total cost of ownership. You know, purchasing the land and the infrastructure and the capital cost that you're sinking into that, it's a really expensive CapEx intensive business. And I think you're sort of limited by how fast you can actually execute on that. But now I like this story where they are partnering with retail, property management, government utilities, and ride sharing especially, right? And they're partnering with these folks to put chargers on their land and on their premises to drive their businesses and service their customers. So I think that's a really awesome growth vector for the business here if they can actually strike good partnerships with the right folks and actually grow beyond what they would be capable of on their own and still be able to brand the EVgo chargers at those locations and still recognize some of that follow-on revenue from customer loyalty and retention and additional offers and whatever else they want to drive into that customer base. I think the partnership model is a great way to complement their own organic growth. The next point here is these guys are positioned like nobody else to capitalize on ride sharing, autonomous driving, and robo taxis, right? So basically, once autonomous driving matures to the point where it can enable those two things, we're absolutely going to see an enormous requirement and a powerful driver for DC fast charging, right? So it's one thing to own your own vehicle at home. You got your Tesla, you plug it in overnight, you charge it, you drive around during the day, and maybe you don't even exhaust the battery during the day, right? So you plug in again the next night and you're good. You don't really need DC fast charging for a lot of these single vehicle owner retail-based use cases. But then if you take a look at ride sharing and where we're getting away from a single owner of a single vehicle, and we're looking at fleet ops, we're looking at shared vehicles amongst many owners and that kind of thing, then fast charging becomes absolutely critical, right? You can't have a vehicle down at nighttime. It's got to be out there servicing drivers in autonomous mode. It's got to be enabling your robo taxi fleet and all that kind of thing. So downtime is lost revenue. And I think for those future use cases that are just on the horizon, DC charging is the only way to really enable that business model and get it done. So these guys are in an awesome position for when that future arrives. The last point here has to do with growth. I like the growth they've experienced to date, and I like the growth that they're going to experience in the future. This deal with GM is pretty awesome. It basically doubles their charging capacity. And it's a huge vote of confidence by GM. There's also a good vote of confidence here by Nissan. And I kind of like this Nissan model, right? Because it kind of points to where the future might go here, where dealers are actually going to collaborate with charging networks to offer, like a year of free charging or discounted charging when you buy one of their vehicles or whatever it is. It's sort of a key way that the dealers can leverage the existence of these charging networks to sell additional EVs and drive that market adoption. And the two can actually start to play off against one another. If that model proves attractive to consumers and other dealers, then that's another growth factor for these guys, which is a pretty great story.
Let's talk about risk.
The first bear case point here is basically the same concern that I had with ChargePoint. I think all of these charging network vendors are vulnerable to future battery density developments, right? So I think that batteries are only going to get better. We are going to see a reduced need for chargers going into the future. And every time I look at one of these growth projections for a charging company, I think to myself, wait a minute, they are basing all of these assumptions on the use cases and the requirements of current battery technology. We know that's not going to be the case, 5 years from now, 10 years from now. And so, what's going to happen when increased battery performance erodes the requirement for charging and sort of curtails what they're able to do, right? The other thing that I think is going to happen is you're going to see increased vehicle efficiency from those future use cases, right? So as great as it is to see autonomous driving and robo taxis and all that kind of thing, I think the sheer number of EVs is going to be curtailed a little bit by ride sharing. I mean, if you can suddenly have one vehicle that meets the needs of 5 users, 6 users, whatever it is, when before you would have needed 5 or 6 vehicles sold to individual people to meet the same need, then obviously overall, not only is the need for the sheer number of EVs going to go down, but the need to actually charge them isn't going to be as great as some of the underlying calculations in these astronomical growth projections, right? So the follow-on point from this is the potential impact that problem has on their total addressable market, right? So I think future battery technology is going to erode the service addressable market, right? So it's going to potentially curtail the demand for DC fast charging by a little bit. And, we have no idea what batteries are going to look like 10 years from now, right? So what are the charging requirements going to be? How often are you going to need to charge these things? What revolution might we see in battery density? It's so hard to predict the future of the technology side of things that I think these projections for the total addressable market and the share market that these guys are going to be able to capture is really pie in the sky, right? Like, I don't know how you can have a lot of faith in these numbers. Every investor presentation they look at for these companies talks about competitive moat. I think, if we saw one of these things that didn't have the word moat at least 5 or 10 times, you would immediately dismiss the company because everybody needs a moat. And I think these guys are scrambling to try to define what their moat is. Just like everybody, they talk about it all over the place. But I don't necessarily see the moat here. I think that, they make a big deal about their ability to find locations and do network planning and configure stations and all that kind of thing. I don't know why they have an ability that is greater than anybody else to do that. I think anybody can do that. So I think that really they're relying on being first, and then their competitors having a high capex cost to come in behind them and duplicate that capability. That's not a great moat. I'd rather see them have some core technology that nobody else can replicate. But of course, that's not going to happen in this EV charging space. Everybody's really competing on the same playing field, except for the market leaders, right? So really your moat is leadership. These guys do have it. They do have some leadership, but that's not a fantastic moat. And neither is this notion of proprietary software analytics, right? That's not something you can essentially squeeze anybody else out of, right? So anybody else can come along and essentially deliver the same software analytics and that kind of thing. So not excited about the moat situation. The last point I'll make here is valuation. And this is the same problem I had with ChargePoint. The valuation seems sky high to me. I mean, that's the case with anything EV related these days, right? It's really, really hard to value these things. But just if you take a look at the comparison with charge point. And just for fun, I did a quick valuation calculation based on the value per charger or per charging station. And if you look at them, or if you look at these guys with 1,412 fast chargers at 2.6 billion, that would give you a value of 1.8 million per DC charger. Compare that to ChargePoint, they were valued at 2.4 billion, and that would have put a price tag of about 21,000 per level 2 charger. I know that's silly, right? We would normally value these companies based on revenue, but if you just look at where they currently sit with the charging capability, I was kind of hesitant that ChargePoint was worth what it was, even at 2.4 billion, let alone what it's worth today on the open market. And I would have the same hesitation at EVgo. Are we really willing to pay 2.6 billion for a company like this, 1.8 million per charging station, basically? The situation is similar in our revenue basis, right? I think that, EVgo is a long way from revenue. We know that. And so you're really placing a bet on a far future valuation for this company. You're placing a long-term bet that DC fast charging is the future and is going to have explosive growth, 5 years from now into 2027 even. So you're making a very, very risky bet on something that may only happen in the future. Okay, so what's the summary here? I think the bull case is really strong for these guys. I think they're an awesome company. The one thing that I'm the most excited about is where these guys are going to find themselves if autonomous driving, robo-taxis, and ride-sharing all become a reality. And the sooner that happens, the better for a company that owns this network of fast charging stations. The problem is that future may take longer to realize than we think. It may take longer than these guys have cash to burn. And I think in the interim, they're going to struggle. They're early stage still, and I think the key drivers of their business are just a little bit further out than I would really like. I could live with that if the valuation was reasonable, but of course it's not. The valuation of all of these companies is sky high. So the combination of paying a really, really high premium for a company that has that amount of risk until they can realize revenue and become profitable, 5 or 6 years from now, whatever it is, that is a little bit more risk than I'm willing to pay to open a position in these guys right now. So it's really hard to say bull case, bear case here, because I think the bull case absolutely wins on its own merit. And the only thing that's making me even consider the bear case on this one is the current hype premium that's built into the valuation. So the way I would play this one is I would put it on my radar. I would wait for a significant pullback. Maybe we'll see it 30 days post-merger. Might be a good buying opportunity. Keep an eye on that. Keep an eye on the warrants. And maybe there's an opportunity to get into this one at a reasonable price. If there is, I would absolutely see if I couldn't snap up a bargain on this one. But at today's price, it's no bargain. So guys, I hope that helps. Please throw the video a like if it does. Consider subscribing, ring the bell, and I'll see you on the next one.